Welcome, my dear students, to SDL Knowledge Hub channel. So, if you haven't subscribed us, please do subscribe. And also share these videos with other children for their benefit. So, today's lesson we will be looking at a very important area for your oral exams regarding the bank reconciliation. So, let's move into today's lesson. First, we'll look at what is a bank statement. Now, the bank statement is issued by the bank, which records all the transactions that happen in the bank current account for a given period. So, it shows all the debits and the credits during that particular period. Now, as you know, the bank account of the business is an asset. So, transactions are recorded in the bank account using the double entry principle for assets. But if you look from the bank's point of view, the current account that is there of the organization, from the bank's point of view, is a liability to the bank. So therefore, the bank will record the transactions using the double entry principle for liabilities. So, bank will record transactions opposite to that of how the transactions are recorded in the bank account. Therefore, money received in the bank account of the organization is treated as debit, whereas in the current account maintained by the bank is credited. Then money paid in the bank account is credited in the organization books, but in the bank's current account will be debited. In this, you would see a sample bank statement, how the bank records transactions. Now, in it, some banks state as withdrawals and deposits, or some banks may use the headings of debit and credit. So, this is a general format or a sample for a bank statement. Now, if the bank and the business records all the transactions related to the current account, the two balances in the bank statement and the bank account at the end of the period should be equal or should be the same. But in practice, there is always a difference. So this difference between the bank account and the bank balance could happen due to several reasons. So these reasons are: 1. Checks issued but not presented to the bank for payment. Number 2. Checks deposited but that has not realized. Then direct remittances that are coming into the bank. Then fourth one, payments on standing orders made by the bank. And also the last one, bank charges and checkbook charges made by the bank. So these are the reasons for the difference between the bank statement and the organization bank account balance. So if you look at the first one, checks issued but not presented to the bank for payment. So by issuing checks in the bank account of the business, the bank balance will get reduced. But since it has not been presented for payment, the bank will not record that and reduce the bank balance in the bank statement. So therefore, because of checks issued but not presented to the bank for payment, the organization bank balance will be less than the bank balance in the bank statement. If you look at the next transaction for the difference between the bank account and the bank statement, checks deposited but not realized. So when checks are deposited, the bank account will record the transactions, but since it is not yet realized in the bank current account, so it will not be recorded in the bank statement. Therefore, in the organization, bank account balance will be higher than the bank statement balance of the bank. The third reason is direct remittances to the bank. So the debtors or any other type of payments or incomes could directly come into the bank current account. So because of that, the bank balance in the current account will increase. But since the organization does not know that such payments are there because it hasn't come through the organization, it will not be recorded in the organization's bank account. Therefore, organization bank account balance will be less than the balance of the bank's bank statement. The fourth reason for the difference between the bank account and the bank statement is payment made on standing orders by the bank. So what is a standing order? Is an order made to the bank in writing by the business to pay a certain amount on a regular basis. So for example, repayment of loan installments, leasing installments, or payment of insurance premiums. So as these payments are made by the bank, so the bank balance will get reduced, but since they are not known by the business, these transactions are not recorded in the business bank account. Therefore, the organization bank account balance will be higher or larger than the bank statement balance. Then the last transactions for the difference are the bank charges and the checkbook charges made by the bank. The bank may charge a fee for the services it renders and also will recover its checkbook cost from the bank account holders. So these will be deducted from the bank current account balance. So therefore, the organization bank account balance will be higher than the bank statement balance because they are not recorded in the bank account of the organization. Now we will look at how to prepare a bank reconciliation statement. So what does a bank reconciliation statement do? It reconciles and identifies the difference between the business bank account balance and the bank statement balance received from the bank. So if you look at the steps in preparing the bank reconciliation statement, first step is to compare the two, that is the bank account balance of the organization with the bank statement to identify the differences. Then step number 2 is to prepare the adjusted bank account, and finally we can prepare as step 3 the bank reconciliation statement. So we will look at each of them in detail. Step number 1, compare bank account with the bank statement to identify the differences. So to do that, you have to check the debit column of the bank account with the credit column of the bank statement, and also check the credit column of the bank account with the debit column of the bank statement. So sometimes the credit column is known as deposit column in some bank statements, and also the debit column is known as payments column. So once you tick all that is there in both the statements, so whatever that is not ticked or unmarked is the reasons for the difference. Based on the comparison of the two statements, as we are already aware and know, there are 5 reasons for the difference between the balances of the two statements. These can be categorized or can be divided into two based on which columns that we have compared. So when we compare the debit side of the bank account with the credit column of the bank statement, for this there are 2 reasons why the difference can arise. One is check deposited but have not been realized, and the other one is direct remittances to the current account. Then we compare the credit side of the bank account with the debit column of the bank statement. There are 3 reasons for the difference. Checks issued but not presented to the payment to the bank, then standing orders and bank charges and checkbook charges. Then we move on to the second step, is to prepare the adjusted bank account. So among the causes of differences, you need to adjust the bank account for the ones that the bank in the organization bank account that has not been recorded. So these adjustments will be as follows. Direct remittances which are not recorded in the bank should be recorded by debiting the bank account, and payment on standing orders which were also not recorded in the bank should be credited in the bank account. And finally, bank charges and checkbook charges which are also not recorded in the bank account of the organization should be credited to the bank account. Then the final step of this process is to prepare the bank reconciliation statement. To prepare the bank reconciliation statement, you have to start with the adjusted bank balance and then add the checks issued but not presented, and deduct the checks deposited but not realized. So finally, based on these adjustments, you will finally arrive at the balance which should tally and which is the bank statement balance issued by the bank at the end of the period. So you can use the format similar to the one that is shown here. Now we will look through a practice question, a sum, how to prepare the bank reconciliation statement from the beginning. So you have been given a bank account and a bank statement. As you can see, there's a difference in the final balance. So you've been asked to state the reasons for the difference between the balances. So to do that, you have to compare both statements and then prepare the adjusted bank account balance at the end of the period, and finally prepare the bank reconciliation statement for the period. The first step in the process is to compare the bank account of the organization and the bank statement from the bank to, to find the differences. As you can see, the bank account and the bank statement is shown here. So the debit column of the bank account should be compared with the credit column of the bank statement, and the credit column of the bank account should be compared with the debit column of the bank statement. So it has been compared, and we have put plus signs in green color where the figures are there in both statements. So whatever that is not ticked is finally marked in red color cross, which are the ones that are remaining, that are not there in either one of the statements. So using that, then we can go to prepare the adjusted bank account and finally the bank reconciliation statement. So now we can prepare the adjusted bank account based on what is not recorded or the reasons for the difference. From that, we only record 3 items, that is standing order, bank charges or checkbook charges, and direct remittances, which are not recorded in the bank account of the organization. So based on the question, there's a standing order for 15,000 and bank charges for 500 and direct remittances for 45,000. So we can record this in the adjusted bank account. So to start recording, first you start with the final balance of the bank account, which is 4,000. Then record the transactions that are not recorded: standing order for 15,000, bank charges for 5,000, and direct remittances for 45,000. And then balance the adjusted bank account. So after balancing, you will get balance of 33,500. So this can be used to prepare the bank reconciliation statement. So we say the business of Lal bank reconciliation statement for the month of May 2021, starting with the adjusted bank balance of 33,500. As we told earlier, you had to add checks not presented to the bank and deduct checks deposited but not realized or unrealized checks. So there's one check that has not been presented to the bank, 25,000. You add that and you get a balance of 58,500. And then deduct the unrealized check, which is for 45,000. And once this is deducted, you get a balance of 13,500, which is the balance as per the bank statement. So thereby, following these steps, we can prepare the bank reconciliation statement. Hope you got a good understanding about the bank reconciliation statement, which is an important area for the O-level exam. So please share these videos for the benefit of other children. And also, if you haven't subscribed, please do subscribe us. So until we meet again with another similar video, bye for now.